time for our 360 round right here on Trading 360. Today, it's Marvell. So the stock is under some pressure. Reported its numbers after the close yesterday. Kim Forrest, founder, chief investment officer at AVGO Capital Partners, is with us, and Daniel CFA, CIO at Fort Pitt Capital Group. Thank you both for being here. Kim, I'll start with you. Your thoughts on what we learned from Marvell, which is down 4.7% today. What were your takeaways from that report?
Well, I think everybody who's investing in semiconductors right now is looking for the win to come in from AI. And here's the good news. Marvell does have AI chips. Here's the bad news. They have a lot of other chips that have nothing to do with AI, including automotive, some optical networking stuff. You know, they're just a good diversified maker of high-end technology, and yet not enough AI. And I think that's really the problem. And that shows up in their guidance for the next quarter.
Yeah, and we're seeing the stock to the downside, but I still see, while price targets are coming down, I'm still seeing the buy ratings. So maybe there's this thought that they could expand at some point. These financial results obviously were not good enough, but what are your thoughts?
Is that to me, Nicole, or?
Yes, please, sorry.
Okay.
Dan.
Sure. Yeah, I think it was, a bit of a disappointing guidance for Q4. I think the big positive there, in my view, is that they did guide for kind of mid 30% sequential growth in their data center segment in Q4. So as Kim mentioned, very strong demand from cloud and from AI, but they're still seeing, some weakness in their enterprise segment, which is, absolutely no surprise and right in line with what a lot of networking equipment companies are telling us as well. So I think for Marvell specifically, it's all a question of, where's the bottom in terms of the inflection point in their revenue. I think that's likely to come in their April quarter. And, if we look at expectations for 2024 earnings per share growth, those are around 50%. So I think once we get through this period of enterprise companies working down their inventory, the picture will be a brighter one for Marvell.
Yeah, and that's what I was implying when I was saying that, you're still seeing a lot of buy ratings. Dan, to your point, you think that AI really grows, so that AI demand account for maybe 25% of revenue next year. So there is potential. Kim, when you think about the competitive landscape and what names you'd more likely buy than others, or the themes that seem to be working, which names stand out to you now? Is Marvell maybe a buying opportunity today on a pullback?
It could be, but your timeline is uncertain about when it could take off. It's diverse kind of industry focus, or let's just call it non-AI focus, has really caused this drop in its value. And it's unfair, but this is the way of investing. This whole year, the NASDAQ has been driven by, a handful of stocks, and they all have two letters in common: AI. And I don't know when this is going to drop out, but what happens is investors glom onto an idea, a technology, a new thing, and then they want it to be delivered to, some kind of productive use immediately. And it always takes much, much longer for that to happen. You should have 3 to 5 to even 10 years as a timeline for AI to play out. But that's not the case right now. Investors think they want these returns sooner rather than later. And so AI is going to be hot. And then anybody else who doesn't really have that much of a proportion is going to be not hot.
Right, understood. Dan, what do you see here? I mean, you did talk about the potential of Marvell going forward. In the meantime, and the impressive lineup of customers that you see that they work with, where are the buying opportunities?
Yeah, so we don't hold Marvell. We prefer some others, and I would put Broadcom really at the top of that list. They're the clear leader in network chips. We really I think it's hard not to like Broadcom's margin profile. The company generates low 60% operating margins. and 50% free cash flow margins, which just is extremely impressive. A lot of that has to do with their decision to strategically outsource the manufacturing of their chips. And now that they've closed the VMware acquisition, about 40% of their revenue is going to come from enterprise software, which is very stable, recurring, highly predictable, annual subscription. So the stock has done really well this year. Valuations have expanded, but the stock trades at about 20 times next year's earnings estimates. We think that's reasonable. We think it's attractive compared to broad semiconductor sector in general, and they should command a higher margin or higher valuation with, again, 40% coming from software.
Yeah, understood. And Kim, just a final thought for a patient investor, maybe, what would you tell them?
Sure. Well, I don't think investing in technology is ever going to diminish, and to pace yourself. We tend to like chips that can be used in many different kind of ways. So we're going more for the kind of Intel AMD theory, where you can use them not only in AI, God knows everyone's building that AI chip, but AI needs a ton of data. And I think that data centers still will need the workhorses that AMD and Intel build just to house that data and gather that data. So it's a pretty good play there too.
All right. Thank you both. Great to see you. Kim Forrest, Boca Capital Partners, Daniel I, Fort Pitt Capital Group. Glad to see you both. Thanks for being with me.